It's a good time then to bring in Pranav Gundapalle of Bernstein to talk about the read-through after the big bazooka that we got from the Reserve Bank of India on Friday. Pranav, great to have you on. You know, just when we were thinking, okay, it's going to be a routine policy, 25 basis points repo, you know, we got 50 basis points of a rate cut and a CRR cut and easing in gold financing norms as well. So quite a Friday, right? Let's distill this down to what to buy. I think that's the big question. And if you could preface that by telling us also, I mean, if you do expect more easing, say, over the next, 3 to 6 months.
Fine. So I think it was indeed a surprise. I think the rate cut was largely penciled in, but the quantum was a surprise. I think they brought forward what would have otherwise happened over a 3-month period. So that's a positive, and CRR was not on anyone's radar, so that's definitely a big positive as well. Now, the way we read it is RBI using the favorable operating environment right now in terms of currency, inflation, etc., to bring forward all of their easing levers upfront. And this should do both help to the overall growth, which should help the lenders broadly, right? I think including the banks as well as the NBFCs. I think both stand to benefit. The CRR would be a direct benefit to the banks. But still, improvement in liquidity will help lower the cost of borrowing across the board. So overall, I think it addresses some of the concerns which had started creeping up once the banking credit growth dropped to sub 10%. I think that should hopefully get addressed soon. And we don't expect any further easing, at least for the next 3 to 6 months, as RBI will take some time to assess the impact of these measures. Before throwing anything new, because we've seen that most of RBI measures, be it to tighten or ease, come with a lag or show the impact of it with a lag. So they'll probably wait for a couple of quarters before taking any further action.
Pranav, hi, good morning. The earlier question, the first one was, what are the stocks to buy?
Yes.
Your list, I remember one view, and I think this came in from an analyst we spoke to on Friday, was that the weaker liability franchise operators perhaps benefit a little bit more. That came in from Digant, I think, Digant Haria. Would you agree? I mean, one of the names there arguably is IndusInd, which you've had a positive view on earlier, at least. So tell us.
Yeah, so I think immediate benefit is for the one with the weaker liability, and more broadly, the ones with wholesale liability franchise. That includes your NBFCs and several banks as well. The smaller ones, IndusInd kind of fits in very well in that description. But also some of the smaller names beyond IndusInd also, which are heavily wholesale funded, will benefit. So they are like the immediate beneficiaries. The second, I think, is on the negative impact on the NIMs. I think that's, again, something that's used for the rank order, where the banks with or lenders with more fixed rate loans will stand to benefit as they see the benefit on the cost of funds without suffering the yield compression. So that's the other way to kind of think of the rank order. Now, what to buy? I think when deciding what to buy, though, one needs to look at what is already priced in. For a lot of the NBFCs, if you look at the expectations, I think the EPS growth expectations are well over 20%, 25%, which assumes rate cuts and the rate cuts leading to growth and some more as well. So with valuations also in the picture, we'll probably still prefer the large private sector banks, the likes of HDFC, Axis, etc., have seen their growth slow down because of tight liquidity conditions. With liquidity easing, we think they'll see a bit of a relief and could drive better numbers and hopefully some re-rating as well. So absolute operating benefits will be NBFCs, but once you throw valuation in, it'll probably be the larger private sector banks.
Throw in some, say a hedge fund asks you what to buy from a trading perspective. What would you tell them? Slightly high, the private banks are sure they're there, and I think you outlined that, but specifically to kind of take advantage of, more tactically speaking.
Okay. See, you just go down the size curve for the banks. So pick any of the smaller banks which are trading cheap. The likes from IDFC First, RBL. Essentially, go down the size curve. They'll all benefit for two reasons: one, the liquidity, and second, I think with RBI clearly indicating that they will be pro-growth. a lot of the concerns that have existed for these banks will also take a backseat now. So yes, I mean, you could go down the size and arguably the quality curve, and that is where you might see the biggest re-ratings as well, especially banks which are trading close to price to book. You will see a big rally there.
All right. Hi, Pranav. Good morning. Good to hear your thoughts. As you said, the NIM compression was something the street already factored in. The CRR cut actually will cushion that. So that's good news. And going by what you're saying, privates over PSU banks and also some of these smaller banks that are trading close to book, well, they'll be the big beneficiaries. But Pranav, I have a very simple question to you. RBI has done enough to spur credit growth from here on, because I think, from an economy perspective itself, that credit growth has been a little bit of a dampener. What are you penciling in for this year, FY26?
We're penciling in 13% growth of banking credit.
All right.
So a 3 percentage point increase from where it is right now.
Okay, 13% growth. That's system-wide.
9%. Yeah.
System-wide growth. Got that. And that's exactly what we got from the SBI chairman as well on Friday. Their own guidance was about 12%, but now with this big gush of liquidity coming in, they're looking at 13% overall credit growth. Just talking about some more of these names or trades or even investments beyond the obvious large private sector banking names, I think you were still negative or underweight on SBI Card, for instance, Pranav. Is there any merit in looking at them? What about gold financiers? Again, I mean, they've already run so much. The question is, what's left on the table? Should one be looking at a Manappuram or Muthoot?
We are positive on the gold lenders. We do like Muthoot. I think they've just come back to where they were prior to all the regulatory noise. So in terms of valuation, I think it still has some legs to run. On SBI cards, I think what's already penciled in, if you look at the consensus numbers, is a very sharp reduction in credit costs, almost an immediate increase in revolvers, some of which seems too optimistic for us. So now, while the asset quality issues are probably done with, we'll see some sort of improvement there. What concerns us, or what's still holding us back, is the trajectory of the revolver. See, one of the structural issues that SBI Cards has been facing is that the revolver ratios are coming off as people find cheaper alternatives in the form of digital loans, PLs from the banks, etc. Their ability to charge 40% interest for your revolvers has come under pressure. And that's
got that. Pranav, sorry cutting you off, because we're running into market opening very quickly. So you yourself anyway said private sector, large banks, then Prashant nudged you, and then you mentioned there are other second order beneficiaries like IDFC. So if I could just ask you, next 1 year, top BFSI bets, top place to look at, what would be the 3 top names be for you?
It would be HDFC Axis and IndusInd.
HDFC Axis and IndusInd. Got that. Pranav, almost a kind of and this is a minority view maybe, but that because things are priced generally so finely, right? You need to kind of go down and find things, stuff which is a little broken, maybe will get better. Down in the dumps. I mean, I've heard things like Bandhan, IIFL has done well recently. Some of the MFI names. Any sense in looking at all of those in a much easier liquidity environment?
Yeah, I think the compounding story you'll get across the board. I think if you look at the list of names that Sudarshan read out, I think most of the banks and lenders are beneficiaries. So it's an overall positive. The tide should lift all boats. Now, I think picking a turnaround story versus picking something that's chugging along quite well, I think depends on what one's risk appetite and horizon is. So in that bucket, we still like the IndusInd. I think at sub-book levels, reasonably shorter tenure of around what needs to go right or what needs to change. We do like that as a turnaround story. But for the others, I think it could be a longer waiting. MFI, for example, I think there are a lot of structural questions to answer before one sees a big re-rating, right? So I think the extent of growth comeback, what would be that look like? Will GLG continue to exist? So a lot of those questions need to be answered. So I would rather just ride with the tailwinds than getting to some sort of these idiosyncratic stories to get that upside.
Well, absolutely. It depends on, ultimately will depends on what kind of player you are and what kind of risk appetite, etc., as you said, but you'd rather much, go with what's already doing well rather than try to bet and turnarounds. Pranav, thank you very much. Good speaking with you as always here on CNBC-TV18. Appreciate it. as always.